The International Monetary Fund set to update its global economic outlook at 10 a.m. Eastern today. We are expecting the IMF to say that the global story continues to deteriorate. Joining us right now on the telephone is Mohamed El-Erian. He is Allianz Chief Economic Advisor and certainly a great student of the global story. Mohamed, thanks so much for calling in. We appreciate your time this morning.
Thank you, Maria.
So what are you expecting to hear from the IMF?
Three things, Maria. One, that the global economy continues to weaken, like you just said. Second, that the balance of risk is now on the downside. And thirdly, they're going to urge central banks to stay as stimulative as they can, not because that's the best thing to do, but that's the only feasible thing to do right now, given the political context.
And do you agree with that, given what you are seeing in the global economy? Do you agree that central banks should not start tightening now?
Look, it's really tough because central banks have been the only game in town. They have really used up most of their ammunition, and it's time now to transition to a more comprehensive policy response. So it's really tough because, you know, Chairman Bernanke, who you're going to have on, reminded us that when you go unconventional, it's about benefit, cost, and risk. And I get the sense that the benefits right now are pretty low, and the costs and risks are mounting.
So in terms of the Fed not raising interest rates, I mean, isn't that, you know, a telltale sign alone that they can't even raise by a quarter point, that things are so weak?
Yeah, I mean, in September, it was about the global economy being a headwind to a U.S. economy that continues to heal. The jobs report has put a question mark on the notion that the U.S. economy is continuing to healing. I think it is continuing to heal, and I would suspect that at the end of the day, there's a 50-50 chance they will hike rates in December, but it's a pretty tough call right now.
Right. Michael Block is in the studio with us. Michael.
Yeah, Mohamed, you say 50-50 chance. Is that purely driven by data? Look, I'm in the camp that says data dependence is not the whole story. They are concerned about A, volatility, B, what's going on in these other countries. With global growth slowing, how do they raise rates? What's the rationale here?
So, Michael, you're right. If they were just to look at the external environment, they would be very hesitant. But you've got to remember a few things. One is we're starting from abnormally low rates. Second, they're worried about what these abnormally low rates do to asset allocation, to risk-taking. And finally, let's not forget that the U.S. continues to create jobs. It's not as if we've gone negative. We've gone to a slower pace, but we continue to create jobs. And that's why I think it's a 50-50.
Let me just follow up. If they do raise rates, what else would you like to see them do in terms of communications about forward guidance or anything like that to perhaps ease the path?
So that's the critical issue, Michael. They've got to help the market stop obsessing about the timing of the first rate hike.
Right, you're right. Yeah.
And help us look at the journey. And the journey is going to be the loosest tightening in the modern history of the Federal Reserve. It's going to be a very gradual path. It will be stop-go. They won't hike at every meeting. And they're going to stop well below historical averages. So what's key in terms of the communication is to shift the market away from obsessing with one timing and to look at the whole journey.
Yeah. Dagan McDowell?
Mohamed, we hear a lot of the same things from investment professionals, market professionals, economists. Tell us the one risk, big risk, that people are missing.
I think the big risk people are missing is that we have been in a pretty special period where central banks have repressed volatility, where they've been able to sit on market volatility and encourage investors to take more and more risk. Yeah. I get a sense that central banks are starting to lose control of market volatility. And therefore, there's going to be a period where prices are going to overshoot, where there's going to be unusual contagion, unusual asset class correlation. And that offers quite a few opportunities for investors to pick up good names at low prices, but they also have to be very nimble.
Yeah, that's a great point, because, you know, you have been talking about this volatility in the markets for a long time, and you correctly called that we would see a downturn really months ago, Mohamed. So where are we now? Do you think we're in store for more volatility? I mean, we're just coming off of the best showing for markets, S&P 500 showing the best showing since 2011. Are we done with the sell-off at this point, do you think, or no?
So I've always stressed volatility is up and down, right? And you're going to have periods of sell-offs and periods of pretty violent retracements. And that's what we're going to see. If I was an investor right now, I would use this period to trade up in quality in stocks and in bonds because the market is offering an opportunity to position better.
All right, we will leave it there. Mohamed, great to talk with you as always. Thank you.
Thank you, Maria.